All right. Nice to meet everybody. My name's David Milanec. I'm a CPA, and I actually consider real estate investing to be a bit of a niche market for both myself and my firm because I've learned quite a bit about it on my own, and then also through a few clients that we've had that have done some of these things and have asked questions about these things. So these are some kind of basic, but definitely important tax planning considerations that you may want to take into consideration if you are a real estate investor. So the big things that I want to talk about tonight would be the following that you see on the screen there. You got risk mitigation. That's going to be talking about kind of how you want to structure holding your properties and things of that nature. 1031 exchanges, which is effectively, I like to call it the biggest cheat code in the tax system, because effectively you completely get out of paying any taxes on a property that you sell, and you can go and then purchase a new property and invest in that new property, and you can continue to do this until you die. Basically, you can do this up until the day you die, and then your heirs then get any property that you would then have at that point. They get a step up in basis to fair market value. So effectively, capital gains never get recognized when you properly execute 1031 exchanges. And then we have a little bit of other tax and legal advice that we can give you that we think is beneficial for the everyday real estate investor. So let's kind of go into it. So the first thing I like to say is that for real estate investing, the strategy that I use for my real estate investors is almost diametrically opposed to what I recommend to just about any other business business owner, I should say. And the reason for that is for real estate investors, you have a little bit of a different consideration here. So, and that is that you have rental income, which is considered passive income under the tax code, whereas most businesses are considered to be ordinary or earned income under the tax code. So it's better for them to incorporate and set up as an S corporation. With real estate, I actually recommend taking and getting an LLC. And it depends on your level of risk tolerance. But if you are someone who thinks that who is okay with a few properties being kind of grouped together in a risk pool, then you could do like maybe 4 or 5 properties in an entity. If you're someone who's like, oh, I don't want any of the risk from any of my properties to touch each other, then you may want to consider even going as far as getting an entity for each property. And when I talk about this, I kind of encourage people to think of it as as like an insurance policy. So if you have an LLC, we have a little bit of an interesting example here on the screen. One is in California, one's in Indiana, one's in Texas. You could actually do this, and this structure that's shown here would actually help you to potentially avoid state taxes as well. But in this setup that we have on the screen here, where we have LLC 1, LLC 2, LLC 3, so each of these properties is held in a different LLC. So let's say that property number 2, the tenant slips and falls and decides, oh, I'm going to sue you. I'm going to try to take everything you're worth. Okay. Well, all they can go after is that LLC. And actually, we can make it we have a little bit of another strategy to make it a little bit harder that I'm going to tell you about later for them to even come after that LLC, because they may not even be in a business relationship with that LLC. They may be in a business relationship with something entirely different. And then the tax filing benefits here. Well, obviously, you're going to eliminate your personal liability by having the entities in the first place. That's going to keep all the stuff off of your personal property, so nobody can come after your personal house, nobody can come after your personal car, anything like that. But then the tax filing benefits here primarily are that you can continue to file effectively on one form. You don't have to, as long as we have single member LLCs, of course. If these are all single member LLCs, you can file everything on your Schedule E at the end of the year. You don't have to file a separate form for that. So that can be really beneficial. Now, I'd like to move into go ahead and talk about 1031 exchanges. So I'm sure most of you here have heard about 1031 exchanges. It's very clearly defined right there. You're going to be able to defer your capital gains tax on any transaction where you sell a property. So there's 4 different types of 1031 exchanges. There's the standard 1031 exchange, deferred, reverse 1031 exchange, and then something called a build to suit. So we'll talk about each of these briefly, and then there's a little bit more after that. So the standard 1031 exchange is not very common. It's the only one that doesn't actually require a qualified intermediary. If you can actually figure out a way to close on a sale of a property and close on a purchase of a property on the same day, then you don't technically need a qualified intermediary to do that. But you have to be able to make sure that you can close on the same day to make that happen. So typically what people do, this is the most common one, is the deferred 1031 exchange. The rules on it are you sell your property. From the day you sell your property, you have 45 days to identify 3 new properties. You then have to close on one of those properties within 180 days. Now, the amount that the new property, the amount of the basis in the new property, which is the cost of the new property, can be any number you want higher than the original property that you sold, but you don't want it to be any lower, because if it's any lower, then the overage is considered a boot for tax purposes, and that is something that you would have to effectively pay capital gains on dollar for dollar. So if you sold a property for $180,000, acquired a new property for $150,000, the $30,000 overage would automatically be considered capital gain that you'd be taxed on. So you don't want that. And then the timelines that we mentioned here, they are completely non-negotiable. So you have to identify those properties within 45 days, and you have to close on one within 180. Now, that said, one of the tricks you can do if you're planning on selling a property, you can start identifying a new property ahead of time prior to the sale of the property, to where you can easily hit both those 45 and 180-day windows. So you can, if you decide, if you're doing a rehab, for example, and in 90 days I'm going to be done with this rehab and I'm going to close on it in an additional 30 days. Okay, so that gives you an additional 120 days from that, in addition to the 45, to go ahead and identify properties if you start looking at that time. And so that's something that you can kind of get a little bit ahead of the game with. So this is actually, like I said, the most common form of 1031 exchange. And this requires that you put your money in escrow when going through the process of the 1031 exchange. And then the escrow money will be released at the close of the purchase of the new property. Then you have the reverse 1031 exchange. So that's going to happen. It's basically reverse. You purchase a property and then you sell a property within 180 days. And if you do that and you meet the criteria once again, where you have property that's valued lower in the sale than the purchase of the new property, then once again you will completely defer those capital gains taxes. Then we've got what's called the build to suit 1031 exchange. So you can actually construct a new property as part of a 1031 exchange. The problem with this is that if you're going to do this, you have to meet that 180-day deadline still. So you can't go and build like, you know, five building apartment complex unless you got some really good, really quick contractors, because you got to get this done in 180 days. It has to be done with 180 days, no exceptions. If you're not done, then you could still be subject to those capital gains taxes. So that's basically the 4 different types of 1031 exchanges. So there's a little bit more that we have in terms of tax planning and everything. So one of the things that I like to focus on with real estate investing is the idea of legacy planning. And I meant to have the word, after example, I meant to have the word limited partnership here. So just imagine that those are there, okay? But legacy planning is going to, if you have a very large holding of real estate, by structuring your entities correctly, you can actually significantly reduce or potentially completely eliminate the inheritance tax that could be levied on your heirs. So in a limited partnership, which is what, if you're going for this type of thing, it's how I recommend to hold your properties. If you have a limited partnership, the limited partners are going to be the people that you want to inherit the property. They're going to be the ones that they're going to have 99.9% ownership. You can do that. You can have it even higher than that, actually. And you can have a very, very small percentage, like 0.1% of the limited partnership. But as the general partner, you retain full control. This does require you to file partnership tax returns. But the great thing about partnership tax returns is that the profit and loss can be distributed however the partners see fit. And if the general partner is the only one with any say, you as the 0.1% general partner can still receive 100% of the profits and 100% of the losses. So it doesn't affect the people that you're trying to pass this stuff on to in any way for tax purposes, but it is going to, when they inherit it, all they're inheriting is 0.1% of a limited partnership. They're not inheriting the actual holdings themselves. They already had the holdings. They already owned the holdings in the first place. All they're really inheriting is that last little sliver of it that gives them the control. And then, so the other thing that I typically recommend to real estate investors, unless you're contracting out to another property management company, is to set up your own property management company. Now, why would you do that? Okay, so let's say you have 10 properties and they're each making you're renting them each out for $1,000 a month. Well, you can enter into contract with your own property management company to manage those properties, and that'll include collecting the rents, doing everything you see there. And if you contract with yourself effectively to manage those properties, you can set the rate, whether you want it to be 10, 15%, however much you want it to be. That money is automatically a deduction from your rental property. So let's say you set it at 10%, you have $1,000 a month for 10 different properties, 10,000. That means $1,000 a month is going to your property management company, and each of those rentals is taking $100 a month deduction automatically, and you can. It's completely legal to do that. You don't lose anything by doing that. You just get an additional tax deduction. And then you also can have expenses for your property management company. Various different things. You can rent out space in your home. You can lease your vehicle. It can have its own phone number. There's any variety of things that any ordinary property management company would have to have. Your property management company can have too. And we can take this to where it also becomes a tax loss for you and generates deductions on your rental properties. The other thing about this is if you have a property management company that you're running yourself, you can have that property management company enter into the leases with your tenants. And that way, that's where it creates that additional layer of separation I was talking about earlier between your property and your tenant, because now it's not only it's completely separating you out of the equation entirely as the investor. It's putting the property management company in the lease contract with the tenant, and then that's completely taking away if you have a holding company for the property itself, the holding company is not involved whatsoever with that contract. So it makes it a little bit harder, makes everything in here, makes it just a little bit harder for someone to come after you. So, and then also, like I said, variety of positive tax benefits that we can generate here out of doing all this stuff. So that's basically my presentation. If anyone has any questions, I'd be happy to answer those questions. And if not, then thank you for your time. I greatly appreciate it. And we are Katz Milanec. Our office number is 708-914-8220. And you can visit us at katzmilanec.com.